Hey, hi everyone. As I said, today's presentation is going to be a little bit long and tedious and boring because it is on some very, very technical information that you may need to know. So what I've done, the way I've structured it is that the very first part is going to be on a really common issue of withdrawing money by way of pension, and then I'll talk about a whole lot of other strategies that won't apply to most of you. So if you've got enough out of the beginning, feel free to log off or just keep listening in the background in case any of it triggers something for you. So I'll just start the slideshow. Okay. So here we go. And today's topic is on how to withdraw money from super. So I did talk about contributing to super a few days ago. I can't remember, the week's been a blur, but that is up on my YouTube channel. So if you want the contribution side of running an SMSF, go to my YouTube channel. Just Google Cass Smith on YouTube. I'm the only one on there called that. And you can watch the contribution one. This one is all just on withdrawals. So I'll get going. I won't talk about myself again, other than to say I have been involved in SMSF accounting and accounting management auditing for over 20 years. So I certainly have been doing this quite a long time. Normally there's not many questions I can't really answer quite easily. So it's not legal or financial, definitely not financial planning advice. It is just factual information that I'm going to give you that can all be looked up on the ATO website and other things. It's all just factual. I'm not giving advice about your particular circumstances. Firstly, I do have to give a big warning, and anyone, if I've got an ASIC spy or an ATO spy watching this, they'll be really happy that I say this. It is illegal to access your super if you're not allowed to. If you don't meet any of the conditions that I'm going to talk about, it's illegal. And do be aware that there are some promoters that have been out there talking about the same thing, same as me, and getting people to set up SMSF, rolling over your money and in saying that you can access it and take it out. You can't, except for these criteria I'm going to talk about. There are heavy penalties, so please just don't do it. Which brings to the very first point. When you withdraw money, unless you meet these conditions, do not use any money for personal use. So the tax office have already released a bulletin this week saying that they've detected more and more people accessing their super when they're not allowed to. They're going to be watching this very, very carefully. So what I mean by personal use is, you know, you're short of money for the week, your car blows up, and you access the money out of the self-managed super fund to fix your car. You just can't. So please don't do it. You are going to get in trouble. So in a nutshell, with an SMSF, the same rules apply that apply to all super. So if you've been trying to get your money out of an industry fund or an online fund and they've said you can't take it, don't think that just because you've rolled it to SMSF you can. It's the same rules. Same legislation that applies to SMSF that applies to all the other funds. So to start with, when you start thinking about wanting to make a withdrawal, you have to be aware you will need to meet a condition of release, which I'll go through, and that even when you meet a condition of release, it may still be taxed. The easiest one of all is that if you are 65, you can fully access your superannuation, even if you're still working. So if you're 65, nice and easy. It's a little bit more tricky if you're under 65. If you've reached your preservation age, which I'll talk about, and I think I'm going to talk about it, and permanently retire, i.e. you do not intend again more than 10 hours a week, That means you've met a condition of release. A little bit blurry, that screen, but this is really easy to find on Google if you just Google preservation age. So if you are before July 1960, your preservation age is 55. Then there's the sliding table. If your date of birth is after July 64, it's just flat 60 from then on in. So for most people, preservation age is age 60. But for some people that were born earlier than 1964, you have a sliding table there. Once you've met your preservation age, you can simply withdraw it. But you will pay tax if you're under age 60. So this is a very common question I get when people are doing their one-on-one consults with me. And this is the idea of these videos and YouTube that I'll put up on YouTube, so that I'm not available for the next 4 weeks. People can have a look at this and get their own answers to their questions. A lot of people say, oh, I've met my condition of release. I've met my preservation age. I'm 58, I'm 59. Can I take it all out? Yeah, you can, but there's going to be tax payable. So a lot of people, I just say, look, unless you really, really have to, wait till you're age 60. Then it's going to be tax-free. So the most common way of most of you, once you've met at the right age and able to withdraw, this is the most common way of withdrawing, which is drawing a pension. And I get a lot of questions. How do I draw a pension? The reason for the questions is that if you're in the online funds, the big ones, you're just a number on a screen. It's very complicated. You've got to fill in a whole lot of paperwork and decide a whole lot of things, and they control the money and they give you a certain amount every month and all of that. That's not the case with SMSF. It is actually as simple as logging onto your Macquarie bank account, your SMSF bank account, paying yourself. It's an internet banking transaction. You can do it weekly, monthly, annually. You can even just do it whenever you want. So once again, once you've met the right age to draw money out, you can simply log on to Macquarie Bank and draw out the money whenever you want. You don't need to contact us and ask our permission. You don't need to contact us and get paperwork. You simply log on and draw it out. There is a minimum that you need to meet to be considered what we call pension mode. And that is between 60 to 65, you must draw 2% of your account balance. So let's say you have an account balance of $200,000. 2% is a minimum of $4,000. You could draw that by way of $77 a week, or you could draw it fortnightly or monthly or annually, as long as you draw the 2%. After age 65, that percentage goes up. I haven't put all the percentages on here. Very easy percentage to find on the ATO website, just the pension percentage. You can draw as much as you like. So there's a minimum, but no maximum. So you have to draw the 2%, but you could draw 2%, 4%, 10%. You could actually draw the whole lot. We do recommend you draw a pension at age 60 once you've retired, because doing so makes your whole account tax-free. We even say draw it even if you don't need the money. And this has been something that we've been doing for as long as I've done SMSF, 20 years. People take the money out. A lot of people will take the money out just in June, before the end of the financial year. They'll log on, they'll take the minimum out, and then they'll put it straight back in if they don't need it. Sounds crazy? Been going on for years, because it makes your whole account tax-free, which is really, really important to pay less tax. We also don't recommend you take out all your super as soon as you turn age 60. So I get that question a lot. People say, well, I'm 60 now. Why am I leaving it in super? The reason you're leaving it in super is all of the earnings can be tax-free. Whereas if you take that money out and put it into another investment in your own name, it's all taxable. Superannuation, particularly once you're in an SMSF, is a fantastic investment vehicle because it's all tax-free. So leave as much in there as you can. Only draw out what you need. So that was the pension side of it. And as I said, that's the basics that a lot of people, that's all you need to know. Don't take it out until you reach age 60 and then take it out however you want. Nice and simple. Going to cover a couple more technical ones. If you don't want to hear these ones because they don't apply, by all means log off or otherwise just listen to me ramble. So here are some other ones: permanent incapacity, temporary incapacity, terminal medical condition, severe financial hardship, compassionate grounds, and the first home saver scheme. Once again, whichever you withdraw under any of those things, sometimes there is tax payable. So once again, if you can, just wait till age 60. Permanent incapacity, not very nice, and very sorry if any of you are in this situation. But if you suffer an illness or an injury and are permanently incapacitated, you might be able to access the super. Your fund, so even though it's your fund, you still have to meet the rules because the auditor will ask for the proof. So the auditor, in your case, must be satisfied that you have a permanent physical or mental medical condition that is likely to stop you from ever working again, but importantly, in a job you are qualified to do by education, training, and experience. So let's say it's me. I'm qualified to be an accountant, and if I suffer a stroke, I can no longer think properly. I couldn't do my accounting job. I might be able to go work as a checkout chick. I would still meet this condition because the condition is about, well, what job is it that you normally do, and if you can't do that job again, you can meet this condition. The next one is the temporary incapacity, which is if you're temporarily unable to work or need to work less hours because of a physical or a mental condition. Don't go getting excited about this. When I first heard about this one, I went, oh my God, that could happen to so many people. But no, that one only allows you to access some of your insurance benefits in super, not your whole super account. In my 20 years of doing SMSF, I've not had a client actually access under this condition. Terminal medical condition, not a very nice topic, but if you have a terminal medical condition, you may be able to access your entire super benefit, regardless of your age. Terminal medical condition exists if you've got 2 registered medical practitioners that certify that the illness and you're not likely to live more than 24 months. And one of those medical practitioners must be a specialist in the area relating to your injury. So, yeah, very sorry if you're in that situation, but you can possibly get out all of your super. And it will be tax-free. So this is the main one that is tax-free if you take it out. Severe financial hardship. I have a lot of people questioning me on this one because of what's happened over the last few years. It's unbelievable to think that there's still people losing their jobs all over this country. A lot of people don't know that. I'm in Canberra, where everybody just is completely oblivious to the hardship that's happening across Australia at the moment. But yes, if you are suffering severe financial hardship, you may be able to get some of your super, but they've made it really hard. So firstly, you have to have been on Centrelink for 26 weeks. So you might be in severe financial hardship because you lost your job 3 months ago. You're still not going to meet this until you're on Centrelink for 26 weeks. And a lot of people in hardship don't even get Centrelink because it's so damn hard to get. So, sorry, I've got fleas in this room. You also need to be able to prove that you're unable to meet reasonable and immediate family living expenses. So that doesn't include just, you know, on a holiday or you can't go out to dinner. It's got to be things like your mortgage. You can't pay your mortgage. You can't pay your rates, like really important immediate family living expenses. To make it even more difficult, they've thrown in these extra things. If you are below preservation age, plus 39 weeks, God knows why. But if you're below 30 preservation age plus 39 weeks, you also need to receive the Centrelink. You need to prove that you're not able to meet the family expenses. And the minimum amount you can withdraw is $1,000 and the maximum is $10,000. And you can only make one withdrawal in 12 months. If you have reached preservation age plus 39 weeks, you still have to be Centrelink, you still have to be not employed, but there's no restriction. So that $10,000 limit, it doesn't apply. You can actually take out more. Okay, compassionate grounds. Medical treatment and medical transfer for you or a dependent. Palliative care for you or a dependent. Making a mortgage payment if the bank is ready to foreclose. You actually need to go as far as getting a letter from the bank to say they're about to foreclose, so that's fairly serious. Modifying your home or vehicle or buying disability aids for a dependent due to severe disability. Expenses associated with death, funeral or burial of a dependent. In these cases, you need to apply to the ATO and you need to supply supporting documentation, otherwise proof that you're in this situation. In this case, there's no $1,000 or $10,000 limit. It's limited to what you reasonably need. So you would need to prove exactly how much you need, and then the ATO will decide what they're going to allow you to take. And once again, even if you're in SMSF, the temptation can be to go, oh, well, I can just access it by logging onto Macquarie and I need money for medical treatment, so I'm going to take it. No, you still have to actually apply to the ATO and get their approval before you withdraw it from the SMSF. And it is also where you have no other means of paying for the expenses. So they're going to want proof that you've got no money in your bank, you've got nothing you can sell, you really, really, really need this money. Okay, on to a slightly more exciting one. Those were pretty dire and horrible conditions, but there is one called the First Home Super Saver Scheme. A bit more exciting. So you can withdraw superannuation contributions that you have put into your super in order to buy your first home. It can only be used by first home buyers. Basically, you can save money by putting money into your super and then withdrawing it for your first home. I'm getting lots of little paper notes telling me things here. Questions. So it's up to a maximum of $15,000 in one financial year and $50,000 across all the years. And say if you're buying as a couple, each of you can access that. So this is a reasonable one to think about planning. I have not seen it used yet in any of my client base. But I guess if you're at the age bracket where you're thinking about buying a home, not that many are thinking about doing that at the moment because of the system or the situation in the world. But yes, if you are thinking about buying a home in the next few years, it is worth contributing more to super, saving it there, and then withdrawing it when you're ready to buy a house. Back to some nasty ones. Let's talk about the tax on it. So there are 3 different components in your super fund. You probably don't know, you've never heard. You've never heard about these things, but it's you've got a tax-free component, a taxable component with a taxed element, and a taxable component with an untaxed element. The tax-free component in super is basically everything that you haven't claimed a tax deduction for. So it's voluntary contributions, downsizer contributions, all the things I talked about in the webinar that's on my YouTube channel that I ran earlier in the week on contributions. Everything that you've put in basically as a tax-free contribution, you can get it out tax-free. Nice of the government to allow that, hey. However, anything that your employer or you or an insurance company or anyone has claimed a tax deduction on, it's called your tax component. Okay, so that is taxed. Then you also have an untaxed component. This one really applies to defined benefit schemes and a few other specialist funds that we've seen. And that is where you haven't claimed it on tax. The employer hasn't claimed it on tax. It's gone in there untaxed. So each withdrawal you make from super is split into those components. The tax-free component there's no tax payable. So even when I mentioned you get it out when you're not 60, the tax-free part is still no tax payable. So sometimes you can get super out of money out of super before you're 60 and still have no tax on it if it's tax-free. Okay, however, lump sum tax is payable on the other taxable components if you're under age 60. So once again, wait till age 60 if at all possible. Okay, this screen's probably very hard to read. It's very easy to find on the ATO portal. This breaks it up. I'm not going to go through every contribution, every element on there. What I'm going to say is that tax on the withdrawals is going to either be 15%, 20%, or 30%. Whereas if you wait to age 60, no tax, okay? Well, no tax on the taxable element. So once again, wait till age 60 if at all possible. And these are the sort of things, if you are thinking about taking out a withdrawal, you're under age 60, you know, it may be worth having a one-on-one meeting with me or one of the accountants to find out how much tax you'll pay. The super funds can also tell you too. If you're going to do a withdrawal from your other super, not your SMSF, the super fund will be able to tell you how much tax they're going to take. That was a lot of mouthfuls I had to talk about. So I will open up for questions now. I will end the presentation. And I'm still recording, so because the questions are helpful for people watching the video as well. But I don't mind if you still keep your camera off. I can still hear you if you unmute yourself. So does anyone have a question on all of that? Delphine? Delphine, you need to unmute. Yeah, you're unmuted, but I can't hear you. No, I can't hear Delphine. So LR?
Hi, Cass. My question is, my super is unlocked and I am able to withdraw it, but with the tax, so say I want to take out 20,000 and the tax is 15% of that. When do I pay that tax? Do I actually have to take that out and pay it at my tax return? How does it work?
No, what normally happens is the super fund will take it out of the payout before they give it to you.
So if I, like being in the SMSF, if I go log on to Macquarie and withdraw it, like I withdraw 20,000, who then takes it out?
Yes, and in that case, it'll go the super fund will give you a payment summary at the end of the year that goes into your tax return.
Okay, and that means that I will have to pay that money from the SMSF at tax time?
Yeah, it's a pretty difficult question to answer because it all depends on all the different types of withdrawals. They're all done differently. So sometimes the super fund will deduct the tax for you. Sometimes you'll get the whole money and then you'll have to pay tax at the end. So yeah, it's best to probably chat with us one-on-one about your exact situation with that one.
No worries. And I can just email Marianne or someone to set up an appointment or send an email through for advice?
Yeah, send it to Mary Jane. She might need to seek technical advice from our technical specialists, which we've got on board.
No worries. Thanks, Cass.
Excellent, no problem at all. Delphine's still got a hand up. If she can work out how to ask the question. So I've got a question in the chat box. Can Mark use his SMSF funds to buy a block of land with someone else who pays part of it? Or can he buy a block of land half with his SMSF money and half with his own money? Look, you can. It's not without its complications. It's probably a lot simpler just to buy it. You can put your money into the super fund and buy the whole block of land rather than try and do it half-half. But yeah, if you really want to, you can. You just need to get a lawyer to draft the contract so that it's owned tenants in common. Super fund owns part, the other person, or you own the other part. Janine, do you have a question?
Yeah, hi, Catherine. Look, I'm just a little bit confused. I just turned 60 this month, and I've been hanging out for that. But look, at the very start of your talk, you said there were certain criteria we needed to meet and conditions of release, and you mentioned the age of 65. Is that for people who are younger than myself? Like if I'm 60 now, I can, like the other lady, can I just take a withdrawal of 20,000 when tax has already been?
Yep. So it's 60 and technically retired.
Yes.
Which doesn't mean not working. It means that you have retired from a job.
Yes.
From age 60. Even if you end up going back to work, you've still met the condition of release.
Yes.
If you left a job, so you're technically retired, there's no rule that says you can't change your mind.
Yes.
You go back to work later on.
Yes. Okay. Great. So I can just set up a weekly payment to myself?
Yes.
Or do a lump sum withdrawal and
absolutely.
And go for it.
Yeah.
Yeah. All right. Thank you.
Yep. Okay. Look, Mark has just logged on and he asked the question, I think, about property. So I'll just repeat it because he wasn't on when I answered the question about buying a block of land, half with SMSF, half with someone else, or half with yourself. You can. Bit tricky. It's probably easier if you just do it in the SMSF. You can contribute your money to the SMSF to buy it. But if you really want to do it, it can be done. You'll just have to see a lawyer and get the contracts tenants in common. Or have a one-on-one with me or one of our other technical people here so that you can make sure you structure it properly.
Can I just expand on that question?
Yeah, sure.
What if similar situation, buying block of land and put all my super money into it and additional of my own money, not from a super fund?
Yes, what I'm saying, the easiest thing to do would actually just be put your money into the super fund and just have the super fund buy the land rather than try and do it half-half.
Yeah, all right, yeah.
That makes sense?
Yeah, even if, I guess, it'll just be adjusted for tax if they put in over the...
Well, you can put into, and that's all on my contributions webinar that I run on Tuesday and that's on YouTube. You can get up to 330,000 per member into the super fund without going over the contribution limits.
Alrighty.
So you can get considerable amount of money into the SMSF to enable that to happen.
Okay, cool. Thank you.
Cool. Anyone else? Janine, I think you still got your hand up, or is that from before?
Oh, sorry. No, that must be from before.
Yeah,
but
no
I do have a metals question, but that can wait till the end.
Oh, well, I think Delphine, I can't hear, so go ask ahead. You're the only other one with the hand up.
Okay, great. Look, I'll be buying some metals for the first time through the fund. I have bought it personally, but I've spoken with the Brisbane dealer I want to go through, And they said to me, well, it needs to be personal or individually insured. So the metals purchased under the funds needs its own insurance, I'm gathering, policy.
No, you don't have to insure the gold at all.
No, okay.
Most people don't, because it's really, really, really expensive.
Yeah, that's what I thought. He also said it needs to be valued each year.
No, it doesn't.
No, I knew. Yeah.
Well, it does, but we do it for you. So basically, in the SMSF, we know what you've bought. When we're doing the accounting, we just look at the spot price of gold and we revalue it for you. You don't have to do it yourself.
Yeah, all right. Well, another thing was I'm renewing my general home and contents insurance, and I was going to get rid of the house contents and just insure the metals, but I don't know what, because they're quite honestly the only thing worth insuring in the house, apart from the building.
Yeah.
Would
so
you do?
As I said, you don't have to insure it, and what you'll find, I mean, by all means, go ahead and get a quote. But what you'll find is you'll fall off your chair and go, oh no, I'm not going to bother insuring it.
Okay, yeah, no, that's all right.
Yeah.
All right, lovely. And look, just one other thing. I started out buying a lot of coins, collectible coins in the metals, and I just don't think that was the best way to go.
Yeah, is that in the SMSF you've done collectibles?
No, that was just personally.
Yeah, good. Okay. Yeah, I just go standard gold, just per ounce. It's a lot easier to buy, a lot easier to sell. And yeah, don't do collectibles in the SMSF. The auditors do not like that.
Yeah, no, I'm aware of that, but I did it all personally. Yeah. All right, lovely. Great, thank you.
All right, a couple of chats from the questions from the chat. Delphine has put her question in there. How do I join a community bank? I have no idea. That's not my speciality. Where do I obtain information about property, land trusts, especially in New South Wales? I think you might be talking about the community properties that some of us are doing. We don't have any that I know of in New South Wales, other than if you Google, have a look up parents with questions. They are doing some of those community farms, I think you might be talking about. They do have some in New South Wales. I think theirs are sold out, but if you get on their database, you'll find out about more. Bron has said she's over 65 and retired, returned to work, over 66 and returned to work. Yeah, absolutely. You can take it out, no tax. Yep, no tax. Over 65, you just take it out whenever you like. So that's excellent. All right, we'll go back to some questions. Joe? Joe, you there? Joe, I can't quite read the name. Joe McDonald. Oh, okay. LR again.
Hi, Cass. If I decide to, say, buy $100,000 worth of gold, how do they work? Like, obviously, if that goes up and down, how do they calculate what's in your super still? So at the end of each financial year, do you valuate the gold and that is the balance, or is that?
Yeah. We look up the spot price of gold on the 30th of June each year and just revalue everything that you've bought. Then that's shown in your statement as to how much you now have in your super.
No worries. Cheers. Thank you.
Got a bit of echo going here, but Joe.
Hello.
Yeah. Hi.
Yes. You. Just a question with self-managed super funds. What age can you close that up?
And take your money out. That's all the things that I've gone through today. So either over 60 and retired or over 65. But as I said, there's no real good reason for taking it all out because it's the best tax environment you possibly want to be. Sorry?
when you close up a super, like as in self-managed super fund?
Yes, you got to wait till you're over 60 and retired, or over 65. Then you could, if you wanted to, take it all out and close it down.
All right, thank you.
Stephen?
Yeah, hi, Cass. Some elements of my question have seemed to have escaped my mind, but it was around the your recommendation to take a pension, over 60. Can you just say a bit more about that? I know you've spoken about it a little bit, but what's the reasoning for that? Whoops, I've lost your audio. I think you're muted somehow, Cass.
Okay, sorry, I'm back.
Ah, there.
Muted myself. Okay, because it makes the fund tax-free. So once we commence a pension, we basically just tick a box in the back of our computer system that then says you're in what's called pension mode, and then all the earnings are tax-free. So let's say you've got $100,000 worth of gold in there. Let's say you make a $20,000 gain on the gold. If you're in pension mode, tax-free. If you're not in pension mode, taxable at 15%.
Oh, I didn't realise that. I didn't realise it was taxable at 15%. Like if for the gains, I thought over 60 or 65 it would all be tax-free. Any gains?
No, and that's why whenever I say over 60 and in pension mode, then you're tax-free.
Aha.
Yeah. And we, as part of our accounting process, we do try and keep an eye on these things. And when you turn 60, we try and say to clients, hey, you're 60, you should take a pension, even if you don't need it. You can literally take it out and put it straight back in the very next day.
Yeah. Okay.
But you've ticked the box that you're in pension, everything becomes tax-free.
And you won't, I guess if you at some point in the future you want to make another like lump sum payment or deposit or lump sum contribution, do you sort of switch it out of pension mode for a sec, or?
No, so what we do is it gets complicated in the back end, but we put it all in pension mode. And then you can keep contributing and it goes into an accumulation account.
Uh-huh.
When that one builds up, we can roll it into a pension account. So that's just all the sort of accounting work our team is responsible for in the background.
Okay. And is that where, you mentioned, I think in another meeting about signing up with you guys to do your tax as well. So is that part of that service or part of that?
It can be beneficial. It's not, you don't have to have us do your taxes.
Yeah.
But it can be beneficial to have us do your personal taxes, more so when you are over 60, because these things start to play together. Okay. So it can be beneficial to have us do your tax return, because then we'll do your tax return at the same time we do the SMSF, so that we make sure that we're capturing all those issues.
Okay. Yeah, thank you, Cass.
Yeah, no worries. Okay, Anne.
Hi, Cass. I'm just wondering what happens if there's two of us in our SMSF and one could collect a pension and one can't. So does it go into pension mode or?
Yeah, very, very common question. So every year when we do this big set of financial statements for you, every member has their own member account. Okay, so this is my daughter's, she's got next to nothing, and then my son's and mine. So when one member starts, so in other words, you're in the same SMSF, but we still manage your accounts separately. Just like your old super fund, whoever you're with, your money's all blended in with everybody's, but you've still got your own member statement. It's the same thing. So when one member retires, they're just starting to draw down out of their accounts. So their account, in their member account, will start going down, down, down. Yours, if you're not retired, yours just stays where it is. That's your component. So with the tax-free status, it's only the member that's drawing down. Their account will be tax-free, not yours.
Yeah. Okay, great. Thank you.
No worries. I should know this name by now, shouldn't I? Josiah?
Hi. Can you hear me?
Yeah, I can hear you.
Sorry, I thought I put it in phonetics.
You've got Joe Asia.
But I had Yoasha written in brackets. But I'm on the iPhone now. I had problems.
Yoasha. Okay, got it.
One of your lovely staff sent me the link on the phone, But anyway, I'm in transition to retirement, and sorry I missed the beginning, so you may have covered this. Recontributions, and I understand you can be in the pension phase before 60 if you're retired, but I've only found out this recently because I took some out last financial year, being in transition, and then I suddenly got a tax bill, and so apparently you can, as you've been saying, when you've got a pension account, it's totally tax-free. But if you're before 60 and you take some out, then they tax you. Is that correct on the whole amount? Like if I'm taking out, for argument's sake, $1,000 a month, 12,000 in the year, does that whole 12,000 get taxed at 15% or what? How does it work?
Yeah, okay, really, really complicated. So yeah, transition to retirement I didn't cover. It's fairly rare, but that is if you are, before you do turn 60, you can take out what's called a transition to retirement. It's only 10% of your account balance, so it's fairly small withdrawal.
Yeah.
And then I did talk about there's 3 different components in your super fund: tax-free, taxable, taxed element, and taxable non-taxed element. Every withdrawal gets split into those 3 components.
Okay.
Every withdrawal, even like if you're taking it monthly, every single withdrawal gets split into those 3 components, and then depending on what that makes, what's that made up of, tax applies to the taxable element. That was a word for it. But yeah, tax is payable before age 60. It's just going to vary depending on your components.
Is there a rough, and I won't hold you to it, but is there a rough, I understand the complexity of it with the 3 components that you mentioned, but is there a rough percentage that you get taxed on, like 50% of the withdrawal or 30% or?
No, it's 15% of, I did, I can just bring that up, that screen that I had up. Bear with me a sec. Someone's just said, have a fantastic holiday. I certainly deserve it. I do. I have spoken nonstop all day today. I'm going to go home, and if anyone wants to speak to me, I'm not going to speak to them. Yep, I'm done talking. All right, I'm just going to share this screen quickly again, and it'll show you basically, won't answer your question, but it'll show you how confusing it is and technical it is.
And especially on my tiny iPhone 7 screen, it's even worse.
Yeah. I was going to say email me and I might send you this link. But if you just Google tax on super withdrawals, this will come up. What it's saying, which you probably can't read, is that under preservation age, which it sounds like you are, the taxable element will be taxed at 20%.
Yes. And
the taxable element untaxed will be taxed at 30%.
Yes.
On the first 1.615 million, and
yes.
then 45% on the balance after that.
Yep. Okay. Rightio. Is that on the first 1.5 million of what you might have in your super, or you don't withdrawing 1.5 million?
Jesus, because if in a transition to retirement, you can only withdraw 10%. So if you're withdrawing 1.6 million, 10%, that means you've got 160 million in your super fund. Probably should pay some tax.
Yeah, it sounds a bit, I'll Google that tax on super. Then.
Yeah.
All right.
Excellent.
Yeah.
Cool. I think there's another chat in the chat box.
Okay, hand downs. Thanks.
Cool. Paying a pension will impact Centrelink. Basically, your superannuation affects Centrelink after age 60. Well, actually, no, not until, I'm not sure about that one. I'm not a Centrelink expert anymore. My sole aim throughout my career has been to help my clients not need Centrelink. So I've never studied up on it too much. So you better ask Centrelink on that one. LR has got a question.
Thanks, Cass. For a super that's been paid with TPD, if I wanted to make a contribution into the super, is that component that I'm contributing available like the TPD payment is? And secondly, do I pay tax on those contributions if I wanted to take it out before preservation, or would that be like drawing a pension? Is it still a better idea?
Okay, so from what I'm aware of, the amount that you've been able to be accessed under the TPD is going to be restricted to that amount that they determined
Right.
you're allowed to get under TPD. If you put in more, that'll go into a separate, like, accumulation account that will be still subject to the normal rules. I think, I'm not 100% sure on that.
No worries.
It is still taxable when you withdraw it. What was your next question?
And that was, I think you already answered it. So say I took a pension at the right age, then it would be tax-free.
Yeah, if you wait until 60, it will be tax-free. So you
No
still
worries.
kind of do that.
And obviously the contributions I wouldn't be able to take out before preservation age because they're not part of that component of TPD.
Yeah, correct. And then whether
No
they're
worries.
taxable or not depends on whether you claimed a tax deduction or not. But if you wait till 60, tax-free.
No worries. Thanks, Cass.
Janine?
Yes, hi, Catherine. Look, just continuing on before, I'm 60 and in retirement mode, but do I really need to contact your office first to get myself into the pension mode to get
No.
that? No. Okay, I could just proceed. Yep.
Yeah, you do the withdrawals. And
okay.
on Macquarie Bank, they've got quite a good capability of adding notes and references and things. You can simply say, Janine, pension payment.
Okay, lovely. All right. Thank you.
Excellent. All right, Stephen?
Yeah, I'm still on that pension mode thing too. Just say you've got 300,000 and 100,000 cash, 100,000 metals, 100,000 land, or something like that. So 2% is the total just the cash component, or is
No,
it
the whole balance.
So if you're running out of cash, you'll have to convert metals or something into to pay yourself.
Yeah, exactly. So what I say to people that are in pension mode is, like, when you go to buy the metals, probably think about how much pension you're going to draw down over the next, say, 6 months, and leave that in cash.
Okay.
And then at the end of 6 months, you might have to cash in some metals to provide the next 6 months, etc.
Okay. Yeah, great. Okay, thanks.
Cool. Any more? If not, I'm happy to log off, and I'm going to go home and pack and leave the country, and hopefully see you all when I get back.
Have a fantastic time, Catherine.
I will. I'm really looking forward to it.
Yeah.
I really, really need a break. I'll come back refreshed and ready to go again.
Well, just one question. Who's going to keep Guru in line?
I don't really follow anything Guru does.
No. All right. Thank you.
No worries. Just one more. There is a question from LR. I'll take the last question.
Thanks again, Cass. If going to buy gold and silver, if I, as opposed to doing it online or maybe over the phone or even going in, do I just give them my SMS details or bank details? How do I organise the payment?
Yeah, so it's definite. You've got to tell them it's in your SMSF. I find the easiest way is to just set up an account on their, on their websites.
Yep.
All the dealers have got create account, and you create an account. You say it's in the SMSF. But you can also just ring them and say, hey, I'm buying in my SMSF. They'll set it all up for you, and then you can do it over the phone as well. They'll send you an invoice, and then you pay for it out of the Macquarie Bank account.
No worries. And even if I do it over the phone, I can organise to go in and pick it up physically or just have them deliver?
Yeah, absolutely. Either they can deliver it for a reasonable fee, or arrange to go and pick it up.
No worries. Thank you.
All right. Excellent.
Have a great holiday.
Yeah, thank you. And we'll see you all in May.
Thanks
Thank
so
you.
much.
All right. Bye-bye.
Thank you.
All right.
go into here.